Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is the 1st of May. Happy Labor Day. Brent crude oil is trading a little bit down this morning. It's been a sort of downward draft this week. Brent crude oil trading in early Asian trade today at 87.86. Let's kick off this morning with Paul Hicken, editor-in-chief of Petroleum Economist. Paul, 1 month out from the OPEC meeting, what do you think is the driver behind this downward draft in oil price? Are we just diffusing the remaining few dollars of geopolitical risk?
No, I think it's much more macroeconomic related. I think it's something you talked about in a show a few days ago as well, which is that inflation is still the elephant in the room for the US. You think about back at the start of the year, we were talking about a plethora of interest rate cuts coming out of the US from the Fed. Now we're talking the potential of even an increase in interest rates, that inflation has not been beaten. Yes, it's still a remote possibility, but at the same time, those sort of interest rate cuts are not as convincing as they were. Inflation's not been beaten, and that all says that if interest rates have to stay higher, that the US growth economic engine is not going to be as strong. I think there's a certain concern across all markets that is the situation. You look across to China again, convinced the market needs more convincing of its demand outlet. Yeah, GDP was pretty strong, but the PMI, leading indicators, have been far from convincing. So I think you look at that situation. I think as a result, there's no foregone conclusions that OPEC Plus is gonna unwind from those cuts at the June meeting. It's going to be looking at, certainly there's clear evidence of a market tightening. There's no question of that. I think, but it's how quickly it's tightening. OPEC's draining that supply, and there is certainly a strong tightening. But when it goes into the June meeting, the crucial May-June data won't be there for them, so it'll be on sentiment and prices. And when you think about sentiment and prices, if you've got this sort of negative sentiment around inflation still hanging over its head, if you've got the sort of question marks still over China, then the prices might not be reflected. We might still be in this kind of range, and it won't be up towards the sort of mid 90s. And if that's the case, then OPEC Plus may still stay its hand.
Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and Senior Fellow at the Global Energy Center at the Atlantic Council. Dr. Charles, at $88 a barrel, surely that's quite a bullish number. I mean, everybody's delighted if you're an oil producer at $88 a barrel. But why then do we have a kind of a bearish sentiment, a bearish tone in the market? Oh, China's not as great as it was, or, US inflation. $88 is bionic for the oil price. Why the bearish tone?
I suppose it is, but because the oil price has been trying to break $90 for a while now, it goes to 90 and then it drops, and then it goes and then it drops. That perhaps colors the sentiment, even though, as you said, $88 is quite healthy. But OPEC and specifically Saudi Arabia have a target to keep it at 90 or a bit over 90. And I read this morning that talking about OPEC Plus and the meeting they're going to have soon, the overproducing countries such as Iraq and Kazakhstan are now presenting plans to cut production further. So that perhaps will boost the oil price a bit, depending on what cuts they have in mind. But another interesting piece of news we had this morning is that Standard Chartered are forecasting that in May and June, oil consumption will go up and it will break the 103,000 million barrels per day limit
of global demand.
That's right. So Standard Chartered is quite bullish that demand is going to go up. If OPEC doesn't do anything at all, and production by OPEC has fell in April a little bit, prices will probably go up.
Dr. Andre Belli, professor, founder, and CEO of Balsan. Thank you so much for joining us, Dr. Andre. There's a number of issues facing Europe right now, and I'm delighted to have you on with us today to sort of get some of your thoughts on that. I mean, starting with the big European elections coming up, where do you see that going, and where is the direction of Europe at the moment?
Well, elections didn't happen yet,
No.
so we are still to see what's going on. But what we certainly observe is a correction of the political intentions and political initiatives towards better realism, rather than dreaming about a decarbonized European Union by 2050 and the world following the European Union in this direction. We rather see a return of the discussion about the competitiveness, about how to place the European Union in the world, and to keep the growing economy, to use the strengths that the Europeans have in technology and in quality of their products in order not to lose competition on one hand against China and on the other hand against the United States.
Paul, we had news overnight that from the weekly inventory data coming out of the U.S. crude oil inventories rose last week, according to the API numbers. Of course, we wait for the EIA numbers as well, typically a little bit more accurate. Your thoughts on this kind of data impacting the oil price? Usually when that happens, it tells me that maybe the geopolitical risk is out of the market and now we're back to some elements of fundamentals. But what do the inventory direction tell you? Are they relevant at all for the bigger trends of the market at the moment?
Certainly, they are relevant to the bigger trends. I mean, I think you've got to take weekly data as you know, it's just a snapshot. But if you look at it over a course of time, for sure, that says about what's happening and whether stocks are being drained. I think there's two questions there. I mean, it's an interesting one because at the same time, while stocks are being drained, OPEC spare capacity is increasing. So it's go from one hand to the other. But it does mean OPEC's much more in control, and there's a certain confidence in the market when that is happening as well. You're right. I think from a geopolitical standpoint, the market is it lulled into a false sense of security? It's certainly calm, and there's certainly a low premium in the market. But in a sense, up until this point, at least, it's been proved right. I mean, there's not much. It's the calculation from getting from any sort of unrest in Gaza to any kind of the tensions between Israel and Iran are certainly trying to be diffused. But that nothing has borne out. It's the market has proved it's correct in that sense, that the premium is low, and it's for good reason, really. And I think you look at why the market is looking at that low risk premium. It's clearly there's no supply being taken out of the market, and the chances of that happening, especially around where it would probably see the big risk, Strait of Hormuz, and the amount of liquids that go through that, is that it's well defended, and it's unlikely to be in anyone's interest for that to be affected.
Dr. Charles, we have the U.S. Federal Reserve meeting later today in the U.S. and expectations there now, where was at the beginning of the year that we would be starting cutting Fed rates at this meeting. Now there's no expectation of that until at least much later in the year, if at all. Your thoughts on where that plays? I mean, it looks like the oil markets have done quite happily over the course of the last 2 months or so, as the news has become more aware that there would be no rate cuts which, you know, would be generally regarded as supportive of prices. You cut rates, there's more money to spend, there's more economic activity. You leave rates higher, it suppresses activity. But yet the oil price has climbed over the last 2 or 3 months as that reality has dawned on the market. What's your thoughts on the outcome for the Fed meeting today? Will it have any bearing on the direction of the oil markets?
Well, I mean, as you said, the Fed meeting will confirm that interest rates are not going to come down, and they will stay high for a while. Maybe there is even a risk that at some stage if things don't improve, rates may go up, and the same happens to a certain extent in Europe. They announced the news yesterday from the Fed had an impact on the oil price. It immediately went down, and the Dow Jones index came down as well. So depending on what they announced today, some of that impact has been already taken into account over the last couple of days. So I don't think we're going to see any major changes if they confirm that the interest rates are not going to change very much, are not going to come down. Prices will stay around about where they are at the moment because of the drop we had over the last day or two.
And Dr. Belli, just picking up on that, if we see the Fed holding rates, and even there's a small forecast that they might even, next step might be a rise rather than a cut, but it looks like Europe is most definitely headed for a cut in June, according to the latest guidance by Lagarde, the head of the ECB. Your thoughts on that, where Europe goes, if there is a divergence of the Fed and the ECB on this rate cycle cutting?
It's a very good question, and what we observe is that indeed the peak of the inflation passed, and therefore the European Central Bank is considering slowing down the rate increases, right? And there's going to be a cut. But the extent of the cut we don't know yet. And what is actually interesting and where the divergence is that the European Monetary Union imposes several restrictions on the central bank currency issuing, and that's basically a point that is now in discussion in Brussels. Kind of interesting to see that expert communities are raising a question about a possibility of changing the ECB practices and the relation of the states towards various limitations on debt, on expenditures that basically would allow the European Monetary Union to be more competitive. But that's again at the level of debates that we hear here in Brussels. Let's see whether the policies will actually go, and that's, you correctly pointed out, we need to see what will be after the European elections.
Paul, we saw, as mentioned earlier, a slight decrease in OPEC production last month, even though we have countries that had overproduced. The overproducing part, Iraq in particular, which is yet to really deliver on its commitment to get back into compliance. Where do you think the direction of those countries go? Kazakhstan as well, overproducing, meant to come back into line in the second quarter ahead of the June meeting. Does that move the needle at all on supply?
Well, I think that is certainly, Iraq is certainly one that the market's probably watching to see if that there's certainly room for Iraq to cut further, the potential to cut further, and even at the OPEC June meeting that they may be chastised and to try to bring them into line, and it might be where the market sees that there's some extra, even if they was to unwind, that maybe Iraq wouldn't be given the same dispensation, that they would have to try and push Iraq and Kazakhstan, the sort of non-compliers, and get them into line. So there's still probably some supply cuts that could well come out of an OPEC cut, even through an unwinding. So that does sort of muddy the picture. And I just wanted to, Sean, I just wanted to mention a bit on the inflation side with the US again, because you touched on it with the other panelists, and I think it's really worth pointing out that this is generational. Like the inflation, we haven't seen inflation like this in the US for decades, and I don't think, you know, some of even the central bankers would not have had to deal with this kind of inflation levels and how you get inflation down, because, you know, back in the day, so to speak, you know, it was a real problem for Western economies. It was something that people thought was beaten, and you know, now it's back, and it's not. And I think there's certainly fears in the market that it will take longer and it must be a harder route to get down to that sort of you know, where
it is a kind of an extraordinary moment where we have so many false forecasts. I mean, the market forecasting 7 rate cuts at the beginning of this year. I mean, while after 10 years of printing quantitative easing, $10 trillion on the Fed balance sheet, I mean, how the markets could even think that you know, this idea that the inflation was temporary. It's kind of an extraordinary misreading of the situation.
Indeed, and I think we're starting to see that, in the sense that when you ask the question, why hasn't the market been more bullish? We've got this tightening. You know, Standard Chartered have talked about these extra supply cuts, you know, it really looks like demand is going to exceed supply for in terms of market balances, and yet you've got this situation with inflation, and it's an elephant in the room for OPEC and the market.
I don't know. There's certain commentators on our show, obviously, who believe the Fed will move with cuts even with inflation elevated because of the burden on the sovereign. Dr. Charles, I wanted to get your insights on all things in Europe gas. I mean, it's a rather unusual situation. This winter ends with European gas storage at near capacity or not far below it. What does that mean for the outlook of gas for European buying and so forth through the what would be the buying summer season?
Well, I was at the Flame Gas Conference in Amsterdam last week, and the mood was reasonably buoyant. But as far as Europe is concerned, the conclusion was that the 20% loss in gas utilization over the last couple of years, only about half of that will be recovered. About 10% of gas demand in Europe they say, is permanently lost. There was also a report last week that suggested that maybe Europe should embrace partial deindustrialization rather than fight it. And that also means that gas demand is going to remain low. As a result of that, Europe doesn't seem to be jumping onto gas or doing anything about gas. Gas, as you said, storages are almost full, not quite full, but there is no problem there. And with gas demand not expected to go up, the US LNG producers are not looking to Europe anymore for exports; they're looking to Asia. So gas in Europe is not going very far. Europe is also not prepared. Many of the utilities in Europe are still not prepared to enter into long-term contracts because of the concern they have that come 2030s, gas demand in Europe will go down because of the European policies, green policies. As a result, overall in Europe, gas is there, but not going anywhere, if you see what I mean.
Dr. Abeglia, I wanted to get your thoughts on, you know, it's sort of a big picture idea, but it's not often we get your wisdom at the table to give us an overview of where European power politics are as we go into this election, the European elections in a few weeks. We've got the sort of the background noise with Ursula von der Leyen being re-elected as the president of Europe, and then we have the recent election of the right candidate, the sort of more Russia-aligned candidate, if you like, in more in the Hungary mode, and then Donald Tusk recently elected in Poland, and the right winning in Holland. Just where are we at in terms of the balance of power in the European matrix as we go into the European elections?
Right. It's, as you rightly said, all trends are open, right? The victory of Donald Tusk in Poland means that conservative party, which is more, let's say, skeptic towards policies in Brussels, has lost the elections in Poland. In other countries, the trend is not necessarily the same. Some right-wing parties are indeed getting the upper hand, but they can be 180 degrees different from each other regarding Russia's policies, right? The Italian right wing, especially Meloni, are very strict on Russia. They don't want to make any appeasements on Russia. The French equivalent, or we don't know whether she is equivalent, Marine Le Pen, is on the contrary, would like to find a dialogue with Russia. So we have basically very colorful political landscape, and let's say very often we hear from mass media that here the right-wing parties are increasing, therefore is a threat. Not always, I would say, not necessarily, but there are obviously political risks, and the political risks would come if the European Parliament at the next elections cannot form a clear majority that would allow consistent policies. And a very probable scenario that we may end up is that European Commission is appointed. We don't know whether it's going to be Ursula von der Leyen or not, but anyhow is appointed. But then the different coalitions on different policy dossiers will emerge. So center right would, for example, ally with left parties on some dossiers and with conservative forces on other dossiers. And this is a kind of like a flexible coalition building is something that is now spoken in the expert communities, I would say. But I would avoid predicting anything. Very often we tend to rely too much on the opinion polls, and we see from year to year the opinion polls have been wrong. So I would say wait and see what's gonna actually really happen in June before saying anything.
Well, we won't have to wait too long in that regard. And if anything, you would imagine that the trend of forecasting to continue to be wrong is probably the most likely outcome, because that's certainly been a very dominant trend since COVID. All forecasts have been wrong. Let's go to speaking of forecasts, let's go to the survey question and see what the forecast is here. What will OPEC Plus agree when they meet in 1 month from now? The 1st of June, it is the 1st of May. Will they no change to cuts in the second half of the year, or agree to unwind cuts in the second half of the year? No change through to the end of the year, which would, by all market projections, trigger a very tight market in the second half of the year. Or will they agree to unwind cuts, or at least some of them? The beginning of the unwinding. Unwinding means they start to unwind. It's not they bring all of them back, obviously, but they agree to unwind in some program. Welcome your thoughts on that. Paul, obviously prices at $88 knocking on 90 for oil producers is a pretty happy number. That context, hard to see if it's not broken, don't fix it sort of idea. Obviously, it's a whole month till June 1st, but given that, all things being equal, a rollover, your thoughts?
I think so. I think there's no reason why OPEC Plus couldn't roll over, because even if it's to the end of the year, it's only till they want to change till they want to unwind. We don't have to wait for an OPEC meeting for OPEC to start unwinding. It's a signal to the market how confident it is about where it sees the balances. But yeah, a month is a long time, but I think there's certainly a good case for a rollover at least till the third quarter. If like some people have alluded to here, I think the key members of OPEC are quite happy where prices are at, and would be probably happier if prices were 90, 95, and are probably more worried that if prices were to drop below 85, 80, and they've already started unwinding, that to put the genie back in the bottle. And that's probably a bigger concern for OPEC Plus, and they'll probably rather wait as long as possible before unwinding, is my sense.
Dr. Charles, your thoughts on that? I'd add this sort of context that we've seen a number of headlines in the last few days, if not the last few weeks, of Saudi Arabia stepping back from some of its big commitments to Vision 2030 and the very expensive spending programs. Obviously, money is not as plentiful as one would hope if you're the Saudi fiscal boss. That Saudi backing away from commitments would indicate they just don't have the money to go through with all of those massive projects. Your thoughts on where Saudi might be thinking, because they're the ones carrying the biggest bucket here on these cuts?
Well, Saudi is becoming concerned that this continuous attack on oil and the future of oil, as IEA, especially led by IEA, especially, is having an impact. And as you probably saw over the last month or so, the CEO of Aramco, as well as the energy minister of Saudi Arabia, have been intervening to express views to shore up oil. But overall, the attack by the IEA is having an impact, and the Saudi Arabia is concerned that investments in oil are dropping. The future of oil is in doubt, and they're being substantially more cautious now about exposing, taking long-term exposure. That is what is driving the situation at the moment. And this morning, I don't know if you have seen the drop in Brent. Brent right now is 85.50. It dropped after the US data last night. It took quite a tumble. It shows that the future is not guaranteed. The oil price is still hovering at lows that make Saudi Arabia concerned. As you said before, Saudi is looking at prices at above $90, $90.95, with a bit of negative data from the US dropping so fast down to $35 is definitely of concern. So I think Saudi in general will be taking a more cautious view regarding their long-term plans and spending.
Looking at the final word, Dr. Belli, the situation out of Russia, Russian oil exports have maintained right through the last 2 years. As the war in Ukraine may heat up in the coming months with this extra weaponry going to the Ukrainians, do you expect that to have any impact on Russia's continued ability to export the volumes they have been?
Again, it's a little bit like with European elections. Let's not try to predict too much, because indeed Russia was able to keep the oil exports, but de facto oil price ceiling was imposed practically by Asian countries who don't want to pay more and want to kind of help in avoiding sanctions, and then they process Russia's crude themselves by exporting it to Europe. Then during recent military activities, Russia lost quite a bunch of oil product capacity, of refining capacity, and we ignore what is the extent of the losses. So it's very difficult to predict. And lastly, Russian authorities don't disclose all the information. And therefore, it's simply difficult to follow what's going on there. It's certainly going to be a player, but a player who is in a difficult situation. And I have always said, let's not underestimate the effect of the sanctions on Russia. Neither let's not overestimate the Western impact on Russia. So the truth is somehow in between.
Okay, we'll have to wrap it up there. Just correcting on the contract. I was looking at the expiring contract on Brent last night rather than Brent, the new contract for May, which is now, as pointed out by Dr. Charles, trading down at 85.55, down 1% in trade today. Oil falling for the third day. We'll have to keep an eye on that trend as it continues. Dr. Charles Elinas, thank you so much. As always, Paul Hicken, amazing as always. And Dr. Belly, love to have you back. Come back more often. You're a very critical voice in our composition of commentators. So thank you for your time today. All the best, everybody.
Thanks
Take
so
care.
much, Sean.
Cheers.
Cheers.
Bye.